For over 10 years, the Federal Reserve has intentionally kept interest rates low to jumpstart the economy. First, it was during the Great Financial Crisis, and then more recently, it was during the COVID pandemic. So as a result, interest rates have been low for a super long time. And if you're a saver, you've been really hurt by this because the interest rate that you earn on your checking account, or your savings account, or even your bonds have been near zero. And as a result, it's pushed people, investors, to take on greater risk, which is why you saw huge increases in the value of assets such as real estate and also the stock market. But because now the Federal Reserve has started raising interest rates, now there are more opportunities to earn more money on your cash, and savings accounts are starting to look a lot better than they did before. So today I want to talk to you about the choices you have on where you can park your money if you want to earn a little bit of interest on your cash. Now keep in mind, cash is a non-earning asset. That means that with inflation, you're actually losing money on cash. And the only reason why you should have cash on hand is to cover your day-to-day expenses, to have for your emergency cash reserve, and if you have money earmarked for a particular purpose. So for example, if you're thinking about remodeling your home, taking a large trip, paying for college, really anything that's going to happen within the next 5 years, you don't want that cash to be exposed to the market. You don't want it invested, but you want it parked in a safe place. But in the meantime, you also want to earn some interest on it because, as I said earlier, the past 10 years, there was really no interest earning opportunities. But now with interest rates being higher, there's a lot more opportunities to earn money on your parked cash, even though it's a non-earning asset. So today I want to go over some of those options that you have available to you. So the checking account is probably the most common account that we all have. And it's the account that we use for our day-to-day expenses. So paying your rent, paying your mortgage, your credit card bills. That's what you should use your normal checking account for. But as far as keeping a lot of money in your checking account, in the past, when rates were very low, it didn't really matter. But now with rates being higher, you don't want to have a lot of cash sitting in your checking account because it could be earning a lot more in interest. And if you're lucky to have a checking account that earns interest, it probably doesn't earn as much interest as it could in a US Treasury bill or a money market or something that's a little more higher yielding. As far as how much money to keep in your checking account, what you want to do is maybe keep 1 month, maybe 2 months worth of living expenses, but just enough so that way you meet the minimum amount for the bank so you don't get charged for overdraft fees. Because the last thing you want to do is to get charged overdraft fees because that way it's going to cost you a lot of money. Another place to park your cash is in a certificate of deposit, also known as a CD. CDs are issued by your local bank or sometimes online banks, and they're a great option because a CD is FDIC insured. However, a CD does have some drawbacks. For example, a CD is very illiquid. So if you buy a CD and it's usually in certain terms, 1 month, 3 month, 1 year, 5 year, you're locked in for that time period. So if you are enticed by a high interest rate and you lock in your CD for a 5-year term and you need that money before that, you're going to pay a penalty to unlock that money before that mature date of that CD. So keep that in mind as you're shopping around for different CDs and whether or not a CD is a good investment for you, because a CD is illiquid, even though it's going to pay you a little bit higher interest rate than a regular checking account will. The next type of account is a high yield savings account. Now, this is mostly offered by online banks such as Amex Bank, Ally Bank. By the way, I have no vested interest in either one of these banks. These are just one of the most common ones that offer these high yield savings accounts. But these high yield savings accounts are good because they do offer a very competitive interest rate. And as of this video recording, they're in a range of about 4.5%. I've seen as high as 5% on a high yield savings account. But these savings accounts are great because they're very easy to set up. They're also very easy to move money between your checking account and these high yield savings account. So if you're in the need for money, you can draw from this high yield savings account and put it into your checking account. Or if you've got some excess money in your checking account and you want to earn a little bit more money, you can sweep that over into this high yield savings account. So they are pretty good as far as flexibility and accessibility. And also high yield savings accounts are FDIC insured. So that's a great benefit for someone who's looking for security in the cash investments they have. Now, if you have more than $250,000 in your savings account, you may want to consider opening up a different savings account at another bank, because that way you're going to have a higher protection of FDIC insurance versus having all of your money in just one bank. Another type of account is a money market mutual fund. Now, a money market mutual fund has been around for decades, a long, long time, but it became less popular during the great financial crisis. And the main reason was there was some risk that the money market mutual funds may not be able to maintain their liquidity, or they may lose value. And as a result, a lot of people got panicked and they stopped using as much money market mutual funds. But in general, money market mutual funds are very, very safe. It's very rare for you to lose money on a money market mutual fund. But just keep in mind that these money market mutual funds are not FDIC insured. So as a result, they do pay a little bit higher interest rate, but they are not FDIC insured. So if you're concerned about the security, you may not want to use a money market mutual fund, even though it's going to pay you a little bit higher yield. So the last option I want to talk to you about is not so much an account, but an investment. And that investment is a US Treasury bill. Now, US Treasury bills are not anything new. In fact, they've been around since the 1920s. But the reason why they're so popular now is because with interest rates being high and the Fed raising interest rates, now they become more appealing. For the past 10 years, US Treasury bills are paying next to nothing, so no one really wanted to own them. But now US Treasury bills are super appealing because you can get up to 5.5% on your interest on your investment, and the interest that you earn on your US Treasury bill is exempt from state tax. So if you've got a US Treasury bill that's paying you 5.5% and you've got a savings account that's paying you 5.5%, that US Treasury bill is effectively earning you more money because you're not going to pay state tax on that interest, whereas on that savings account, you're going to pay federal income tax, and you're going to pay state tax. Now, if you're in the high tax state like California or New York, that's going to be a huge savings for you because you're going to avoid a lot of state income tax on that interest. Now, buying a US Treasury bill is a little bit different than opening up an account, like a savings account. There are only a couple of ways you can buy a US Treasury bill. You can buy directly from the US Treasury. So if you go toustreasurydirect.gov, you want to make sure it's got .gov on the end of it, so that way you don't go to some spoof site. So you can buy directly through the US Treasury, and I'll put the link below in our notes. The other way you can buy it is through your brokerage account. So if you have a brokerage account, you can buy US Treasury bills through your brokerage account, and that way you can hold them just like you would a stock or any other investment. And then when they mature, you get the full value of what you invested plus the interest that you earned on that bond. So hopefully you found this video helpful with all the different options you have available for your cash right now. The past 10 years, there was very few options available for your cash, but luckily with interest rates going up, you have a lot more options such as savings accounts, CDs, and I think the best investment option now available is a US Treasury bill, most notably the US short-term Treasury bills, probably in the 3 to 6 month range.